Welcome, Freedom Friday. So listen, let's get right in. I've been receiving a lot of calls and just some really good questions about where we are with the market and what should they do and some advice and stuff like that. So I always say this: there's several markets, right? You got your stock market, your bond market, credit market, money market, real estate market, commodities. So I want to put hard assets to the side because I really don't see impact in hard assets as of right now. So when I talk about hard assets, real estate, right, rental properties, if you're especially if you're receiving cash flows, you shouldn't be impacted as of right now. As long as your cash flows are they're going to help you weather the storm. So I'm going to put that to the side right now. Put gold and silver to the side right now. And I just want to focus in on the stock market. Okay, so basically from the calls that I've received or messages or texts or whatever, it comes to basically one question from all these different folks, right? And the question is, are we there yet? And what they mean is, are we at a bottom? Is this a good time to start piling into the stock market? And it depends, right? So I'm gonna start off with this analogy. Let's say you go to your favorite grocery store and you want to get your favorite cut of meat that you always get. And typically it's $15 per pound, and you usually get 4 packs, so that's $60, right? Simple math. Well, you go to your same this favorite store. The butcher comes out. The butcher says, "Hey, we got a deal for you. Instead of $15, it's half off, right?" So instead of getting your 4 packs that you usually get, you double down and you get 8 packs, right? But the butcher says, "But hold on, there's a catch." Okay, you have to prep, cook, and eat your meat or whatever you buy within 4 hours of purchasing, because it expires, it's going to go bad. And when it goes bad, and if you eat it, it's going to mess your insides up. You're going to be throwing up and all the, you're going to have a bug, if you will. So you're like, 4 hours, that's not feasible. I can't go home and prep and cook and eat all within 4 hours. There's traffic, getting back, and it's just not going to make sense. So what perceived to be value is not value anymore. Well, that's kind of where we are with the stock market, right? So you're going to get a bunch of headlines. You're going to see the Dow dropping 2,000 points and all that stuff. And you're going to see certain sectors and certain stocks that are 80% below their high. So when they were at their peak, they have dropped now 80%. And that's going to look like a real bargain. And it may be, but how are you going to determine the value, right? So typically, there are different metrics out there, and one of the more popular metrics is the price earning ratio. So the P represents price, and the price is the current price of the stock, right? So if you log on to any financial website, Yahoo Finance, and you look at Facebook stock, you can currently see where Facebook stock is trading from a second. You can see it going up and down, up and down, up and down. Okay, so that's the price part. That's easy. It's the denominator, which is the E. The earnings is where it gives us trouble, because typically the earnings look backwards. The earnings look at the previous 12 months or the previous quarter, okay? And they determine the earnings using the previous data. Now, you can project the forward price earning ratio, the forward PE, using assumptions. Well, that's nice and fine when you have a company who has, consistent orders, and you can kind of project out the sales and then the earnings and all that. But when you're in the market, kind of where we are right now, with a crisis going on, and you have some companies that are coming out and they're canceling their earnings for the rest of the year because there's no way that they can predict their earnings. So why say our PE is going to be this or our earnings is going to be that, when I can't gauge? I got customers who are canceling all the time and stuff like that. So you can't really value a company if you don't know what their earnings are. If I don't have your earnings, if I don't have your revenues and your expenses, and then your profit, your bottom line, there's no way to really put a value tag on it. So seeing a price earning ratio go from 16 2 months ago, from on a particular company, to 5 looks attractive. You might say that's a bargain, but those earnings may not be sustainable, or those earnings might not be the true reflection of where the company is now. So you can't really value the company. So I'm saying all that to say, you can't really say that the stock market is at a bargain if you don't really know how to analyze that particular company. Now, what I would do is, first I would want to look at companies that have weathered recessions in the past. Don't give me a company that just IPO'd last month, or a company that IPO'd a couple years ago and all they know is a bull market, the market going up and up and up. and they haven't really been through a recession because you just don't know, you don't have the historical data to see whether this company is going to rebound or not, right? So that's number one. So I want a company that's been there, that's tried and true, brand recognition, okay, like a Exxon maybe. And then secondly, I want a company that has a lot of cash on the balance sheet. They can weather the storm, right? They got savings. So if the market does take a dip, or their recessions do take, their earnings do take a hit because of a recession, they have enough cash to weather the storm. And I always tell people, look, when you want to invest in a company, you have to look at it as though you're lending money to a friend or family member. Individual, it's the same concept. Are you going to lend money to a family member that has no job, that's not very trustworthy? Their credit is shot, and I'm not talking about their credit score, but just their credit with you, like their credibility, like they're not trustworthy, they're not truthful, they always got some story or some excuse. It's going to be really hard for you to lend money to that person because you're basically knowing that you're lending money and you're not going to get it back. Whereas you might have another family member or friend who is trustworthy, does have a reliable job, and they're just going through a little rut right now, and they just need a little money to get them over the hump, and then they'll be able to pay you back. That's who more likely you're going to lend money to. It's the same thing with a company. Why would you invest in a company that has no cash, that has a bunch of debt, money they have to pay back, and they have no earnings to do it with? They're going to file bankruptcy. They're going to be in Chapter 11 next month. Or there's going to be a bigger company that's going to swoop in, buy them out buy them out at a cheap rock bottom prices because they're not sustainable. They're looking for somebody to throw them a lifeline. Hey, buy me, bail me out. So you want to stay away from those companies. And also, dividend yields right now look extremely attractive, right? You're getting some 10% dividend yields, you're getting 12% dividend yields. You want to do your research with that as well. You want companies that have a history of not only paying their dividends, but increasing their dividends, because that's letting you know that they're getting more cash in and they can afford to pay out their dividends and also increase. Because in trying times, the first thing that gets cut is the dividend. Okay, so you might have a 10% dividend yield, looks really good, looks really attractive right now, but in a week or so or a month or so, that same company, that CEO is going to come out and say, hey, we have to cut our dividend or we have to halt it until further notice because we're trying to survive. So again, that goes back to the cash on the balance sheet. It's no different from an individual. If a person is living paycheck to paycheck, it only takes one paycheck to wipe them clean. Okay? Same thing with a company. If a company's borrowing a bunch of money to stay afloat, it only takes them missing one debt payment to clean them out. Okay? And I'm going to leave you with this. Because cost of capital is so cheap, and it's been cheap for a very long time, a lot of companies have borrowed a lot of money. Now, that's not necessarily a bad thing when the company that's borrowing the money has a lot of cash and they can pay it back with no problem. They're just being smart because they're saying, hey, when am I going to get interest rates this low again? Let me borrow a lot of money. That's fine. They got a lot of cash to pay it back. It's the companies who are forced to borrow the money just to stay afloat. I need this money because I don't have enough cash coming in, so I got to borrow so I can pay my employees. Those are the companies they're going to file bankruptcy. You want to not invest with those companies. And then there are some companies who borrowed a lot of money to buy back shares of their own company to make their stock price look more attractive. Well, guess what? When they stop buying back that stock and they got to pay back this money, bankruptcy. Stay away from those companies. So I'm going to leave you with this. Brand recognition. An Exxon, Coca-Cola comes to mind, maybe American Express. I'm just throwing out names right now. I'm not giving you any recommendation, just throwing out names. Apple, Google, these companies have a brand recognition. They're dominant in their field, and they have a lot of cash. These are companies that you want to take further look, to do more research with and possibly become an investment down the road. Just don't fall victim to what looks good. Oh, this company is, 80% off its lows, or it's trading at 50% than it was last week. It must be a buy. I'm going to buy. That's the wrong attitude. You do want to buy when there are steep discounts, but you have to buy quality. You have to know what you're buying, and you have to buy quality. Just don't go in there and blindly invest, okay? So if you have any questions or any concerns, or you just want some advice, we're here for you to answer those questions and to help you out and kind of, restructure your portfolio. But that's where we are. We would not recommend just people just going in and buying whatever stock they feel is at a value. That's what you call a value trap. Company may look good and it's glittering, but it's going to take your money and run. Okay. So that's what we're going to leave you with. New Level Realty, Freedom Fridays. Good luck.